Hi friends, good day. Today let us try to understand about what is dividend, what are the important dividend dates, what is dividend yield, what is dividend payout ratio, and what are the interpretation of dividend payout ratio through this video. According to Philip Fisher, the stock market is filled with individuals who know the price of everything, but the value of nothing. Before we go in,
Please subscribe for more videos. Click the bell icon for updates.
what is dividend? A dividend is the payment made to the shareholders as a reward, cash, or otherwise. It is the distribution of the company's earnings to the class of its shareholders. Dividends may be paid out in cash or in the form of stock. A stock dividend is the dividend payment made in shares rather than cash. Basically, it is a thank you note to the shareholders or the investors for investing or holding on to their shares. A company's dividend is decided by its board of directors and it needs the shareholders' approval. The company is not obligated to pay the dividends. Dividend is usually a part of the profit that the company shares with its shareholders. The stock dividend has the advantage of rewarding the shareholders without reducing the company's cash balance, although it can dilute earnings per share. While the major portion of the profits is kept within the company as retained earnings, which represent the money to be used for the company's ongoing and future business activities, the remainder can be and is generally allocated to the shareholders as dividend. Sometimes the company may make dividend payments even though they don't make suitable profits. They may do so in order to maintain their established track record of making regular dividend payments. Important dividend dates. Dividend payments follow a chronological order of events, and the associated dates are important to determine whether the shareholder is qualified for receiving the dividend payment or not. Announcement date. Dividends are announced by the company on this date and they must be approved by the shareholders before they are paid. Ex-dividend date. The date on which the dividend eligibility expires is called the ex-dividend date or the ex-date. Record date. This record date is generally the cutoff date established by the company in order to determine which shareholders are eligible to receive the dividend or the distribution. Payment date. On this date, the company issues the payment, which is when the money gets credited to the investor's account. Since the dividend payment means the money going out of the company's books and accounts of the company forever, therefore they impact the share price. It rises on the announcement approximately by the amount of the dividend declared and then declines by the similar amount of the ex-dividend date. Now let's look into dividend yield. The dividend yield is a financial ratio of the dividend paid and the price of each share and is expressed in percentage. This shows how much a company pays out as dividend each year relative to its stock price. It is important for the investors to keep in mind that higher dividend yields do not always indicate attractive investment opportunities because dividend yield of a stock may be elevated as the result of a declining stock price. Assuming the dividend is the same, neither raised nor decreased, the dividend yield will rise when the price of the stock falls and will fall when the price of the stock rises. Dividend yield is equal to annual dividends per share divided by price per share into 100. For example, a company has a stock price of Rs 200, declares a dividend of Rs 20. The dividend yield will be 20 divided by 200 into 100, which is equal to 10%. Often the high dividend yield stocks are good investment options during volatile times, as these companies offer good payoff options. They are suitable for risk-averse investors. Companies with high dividend yield normally do not keep a substantial portion of profits as retained earnings. Their stocks are called income stocks. The opposite or the contrast of this is the growth stocks, where the companies retain a major portion of the profit as retained earnings and invest them to grow the business. Dividend payout ratio. The dividend payout ratio is the ratio of the total amount of dividends paid to the shareholders to the net income of the company. In other words, the dividend payout ratio measures the percentage of net income that is distributed to shareholders in the form of dividends. DPR, that is dividend payout ratio, is equal to dividends or dividends per share divided by net income or the earnings per share. The other formula that can be used to calculate DPR is DPR is equal to 1 minus retention ratio. Retention ratio measures the percentage of net income that is kept by the company as a retained earnings and is the opposite of the dividend payout ratio. Let's see what is interpretation of the dividend payout ratio. DPR helps the investors in determining which company suits best with their investment goals. When a shareholder invests in a company, return on their investment comes from two sources. One is dividends and the other is capital gains. These two sources are related as a high DPR indicates that the company is reinvesting less money back into its business while paying out relatively more of its earnings in the form of dividends. Such companies tend to attract income investors who gives more preference to the assurance of a steady income than the high potential for growth in share price. A low DPR indicates that the company is reinvesting more of its earnings into the expanding of business. By investing in the business growth, the company will likely be able to generate higher levels of capital gains for the investors in the future. Therefore, these types of companies tend to attract growth investors who give preference to potential profits from a significant raise in the share price and gives less preference to dividend income.
Well, thank you so much for watching. Please like this video and do share.